Hello, everybody, and welcome to another episode of the Vidor Locksmith Show, where we are unlocking the secrets to success, one interview at a time. Hold on, I need to adjust my computer just a little bit. And of course, it was kind of overcast all morning when I was getting this set up, and now there is more than enough sunlight, and so I think there's a little bit of a glare. I apologize, guys, but I'm on vacation, so I really don't care, honestly. I am standing in front of the Lincoln National Forest here in Cloudcroft, New Mexico. I've been enjoying my time away from all the hustle and bustle of the cabin fever life, and I'm actually in a cabin experiencing cabin fever. So having fun with it. Hopefully you guys are having an amazing week as well. We've got an amazing show lined up for you today. I know a lot of you people out there know who this person is. They have made an absolute amazing statement on LinkedIn and in the oil and gas industry, bringing you very, what people may say as controversial topics, but data-backed controversial topics. He's happy speaking his opinion and being able to back it up with some great evidence. We've got David Ramsden-Wood on the show today. So, guys, first and foremost, please, give a shout out to a friend or comment, tag somebody in the comment section. Let them know, the show's going on today and that they could, educate themselves. We're doing it on Thursday. I also have to mention we're doing it on Thursday because tomorrow's July 3rd. It's supposed to be, I don't know what you call it, like viewings of the July 4th holiday. So I know a lot of people are going to be working tomorrow. So I figured if it was going to be on a work day, let's at least do it on Thursday so that you have a reason to not do any work 2 days in a row. Trying to think, tell us where you guys are watching from. Please, share this with your friends. Let's, get the numbers up there today. Show support for our oil and gas family. Let's see. So far, that part is still broken. That's not updating at all. So I can't even see any of the stuff on LinkedIn. I'm trying to do this all from one monitor today. So that is completely new. So let's go back over here to this one. Let's go back over here to our comments. We got a couple of people watching. We've got, you don't have to care. You are being awesome. Thanks. I did an interview with her this week. Kenneth Miller. Ken Miller's watching. Thanks, bud. It's hard to see these. So, Mr. Kareem watching from Algeria. Thanks. Oh, and thanks for bringing this up. Eric Allen said, check the battery. So if you guys had never watched the previous episode that I did with Mr. Ramsden-Wood, the batteries died. I actually was filming that one at Kenneth Miller's location at Erdos Miller there in Houston to be able to actually do the interview with David. Drove into Houston early that morning. I had to completely set up my entire studio and set in a foreign room, a foreign location, and I messed up. I did learn from my mistake. I have the battery charger plugged into my laptop, even though it's not the right size because I left the actual charger plug back at the house in Austin. But we found another one, but it actually says that it's not the right size. So we could still have the battery issue again today. Hopefully we don't. But, hey. We've also got somebody watching from Tunisia, Asil. I'm going to butcher a whole bunch of people's names. Mr. Ozzy Silva is watching, and he's giving a shout out to John Weatherly. Love both of those guys. Eric is watching from Mexico. We've got Nikita watching from Houston. See if we can get a couple. Patty Murphy, who's always a big fan of the show. Thanks for watching. And then Abbas watching from Dubai. Love having you guys all watching from around the world. Could have been a super freak. You called out my name. My speakers are super loud, and it was like you were yelling at me across the room. Ken Miller. Sorry. Now I just broke everybody's eardrums. I think actually somebody inside the house is now looking at me. Sorry, guys. Paul Moore is actually from Rio Doce, New Mexico. He's right down the street from here. All right, guys, I'm going to play the quick little commercial. We're going to get straight into it. I'm going to do the best that I can today, being able to direct the show with just a single screen, with an amazing guest. We've got a ton of people already watching today. Hey, guys, let us know if you're watching on YouTube or on LinkedIn. The YouTube crowd is definitely growing. Never anticipated that. Sorry if I get distracted. Yesterday I was doing an interview, like a bird dive bombed me out here. So kind of have to be aware of the hummingbirds. They can be aggressive. Tyler Qualls saying, yo, from Dallas. Tyler, thanks for watching. Always appreciate that, buddy. All right. Where is the button? Sorry, guys. Still having to get used to just this one. So where is it? Are you ready? All right. So this is a quick little promo because this show, This podcast, this show, and the other show that I'm about to show you is brought to you by Gibson Reports, GibsonReports.com. If you want to know anything about the directional drilling MWD market share business, there you go. That's my sponsorship for today, and I'll stop being a salesperson. All right, guys, without further ado, David Ramsden-Wood of hashtag Hot Take of the Day. If you're not following hashtag Hot Take of the Day, go and do it later. Not right now, because he's here in front of you to be able to answer your questions and teach you about financials for non-financial people. That is definitely for somebody like myself who's made tons of financial mistakes. So hopefully I won't make the same ones that a lot of oil and gas companies have been making lately. So, David, thank you so much for being on the show today. I really do appreciate it.
David, thanks for having me. I'm excited to be here. I've been looking forward to getting back on since the infamous battery incident, and so I'm looking forward to chatting again.
Yeah, so this isn't really like episode number 2. This is a continuation of episode number 1.
Yes,
essentially. Yeah. We just took a pause in there somewhere. So
we did. We took a pause, and we've had. Man, I was trying to think about the time frame that we did it, and it was probably September 2019, right? So it's been almost 10 months.
Yeah. A lot of things have changed.
A lot has changed, but and so when you and I started talking about this, and you said, "Hey, would you come on and maybe give some more depth to the things that you talk about every day?" And for those who've followed me on Hot Take of the Day for the last time, or for the last 19 months now, you'll know that the thing I say all the time is hope is not a plan. And for too many companies, they're kicking the can down the road with their financial statements and their financial balance sheet. And that's what got them in trouble. So yes, I turned out to be right on all the things I've been calling for the last 18 months. But I was right for an exaggerated reason. And I will say, as a lot of people know, I really, truly believed that oil would be $60 right now. All the things that would happen over the next 6 to 12 months now would have happened over 3 to 5 years, but it's massively accelerated because I did not expect the U.S. would shut down because of COVID. So that accelerated everything that was going to happen anyway. But today we're going to go through financial statements and help you build the skills so that you too can be ahead of these companies when and not get caught with your pants down.
Well, I appreciate you definitely being here and being able to bring more light to this topic. What do you think, as far as the things that you were saying back in September, how you might have changed your mindset to what's going on now?
Well, so I will say I discovered that I'm more of an optimist than I thought I was. I think most people who would follow me would say that I was pretty pessimistic. I always considered myself a realistic, and apparently I'm optimistic. So coming into 2020, I was positioned with a long position towards 3 companies, but one in particular that you've probably heard me talk about, CDEV Resources, Centennial Development Resources. And the primary reason was because I was giving speeches going back over a year that said 95% of oil and gas companies are fundamentally 50 to 100% overvalued. And I picked the 5% of companies that I thought were relatively undervalued in a $60 world, and I went long, which is optimistic. Now, the pessimist would have shorted the entire industry of the other 95%, and I would have absolutely killed it. And so I will say I have changed my investment philosophy to be more realistic. And so I am short the entire oil and gas sector in terms of public equities. And so I want to make sure that people understand that I'm not talking my book because my position isn't large enough to really care. I'm not a hedge fund manager of billions of dollars. Me personally, I am short oil and gas. It is my only position that isn't cash. And we're going to walk through the reasons why I believe that public oil and gas stocks are so massively overvalued that you cannot own them. It's very popular with management teams.
So I got one question for you before I let you get into it. So as far as if you're being short the oil and gas sector, and I know a lot of what you're going to be able to talk about today is potentially like the operators. What about the service industry? Because I mean, there's not a lot of publicly traded oil and gas service companies. I mean, we've got kind of like the big four or whatnot, but there's a couple of other ones that are peripheral that are also publicly traded. Some of the smaller cap ones. What are your thought process on them and the oilfield service sector as a whole? Because I know a lot of the people that are watching today are, my audience is people that are in the drilling, upstream, and oilfield service sector. So I know that they would like to be able to get probably some kind of connecting the dots between those two or between the operator and the service companies.
So I wanna be clear that I'm differentiating right now the equities versus the company. And so, as you saw with Chesapeake, as you've seen with Extraction, as you saw with Whiting, as you saw with Unit, all of those companies have recently declared bankruptcy. And bankruptcy, by definition, is a legal process where you go through and restructure your debt to convert it to equity. Now, we're going to talk about this in financial statements, but it's really important to know that when you own shares in a company that is common equity, it has no seniority in terms of getting your money back. So it is the most risk capital that is available to have. Debt holders always get their money back. And if they don't, the shareholders get totally wiped out. So service companies, we were running 948 rigs, January 1st, 2018. Now we're somewhere around 200. We were running 350 frac spreads in October of 2019, around, David, when you and I spoke. We're now running about 70. So the sheer level of activity is down 80%. Most of those rigs will not go back to work ever. And so what's going to happen to the service companies? Well, clearly they need to consolidate to save G&A. And they're going to end up scrapping a whole bunch of equipment and either moving it overseas or just cutting it up so that the supply is taken out of the market so that they can control their pricing more. And we'll talk about this, but you might see more vertical integration. E&P companies have historically moved away from owning service rigs and owning fracs and owning drilling. But if you can truly buy that equipment because they're in auction for 3 cents on the dollar and you're going to run a rig in the Permian or 20 rigs in the Permian, are you better to run the equipment yourself and internalize it? I think that we'll review that market. But that's a long way of saying the service sector is really, 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 really in pain because we just aren't running activity. And I don't foresee activity will ever get back anywhere near where it used to be. At best, I prognosticate there will be no more than 200 drilling rigs running and 100 frac fleets running for the next 3 to 5 years, tops.
So do you think that the problem that the operators have created a crisis essentially for the oilfield service sector?
Oh, absolutely. And I mean, I called this for the last 18 months, it's been a crisis of balance sheets for operators. But the problem with service companies, and it comes down to a strategic analysis, is anyone who was able to raise capital was building a frac fleet or building a rental fleet or building anything. And so the number of very small service companies that were running like it was 2012, trying to fill a niche and undercutting pricing of the other guys to get market share, that was a cycle that now they're just, there's 80% unutilized capacity. When you have that, you can, there's someone more desperate than you to keep their employees at work because their bankers are going to take all their equipment. So they'll undercut you for longer than you can survive. And so the unfortunate thing is that level of so much equipment is going to reduce pricing power, and that will lead to almost everyone being wiped out. I would suggest there will only be 2 service companies left at the end of this in the next 12 months, and that will be Schlumberger and Halliburton.
Wow, that's a really strong statement. I won't hold that. I won't hold you to that one. But it's very interesting you say that with the oversupply of equipment, because in 2015, 2016, we saw a lot of, for me, I'm in the directional drilling MWD space. We saw a lot of the MWD directional drilling companies that went bankrupt, and there were companies that were able to buy all of those assets for pennies on the dollar. And then all of a sudden their barrier to entry and their price margins were completely different from everybody else. And so it's interesting that you say, it's either those assets are either going to be scooped up and vertically integrated, somebody else is going to be able to come along and grab them, be able to be at reduced price, or those things need to be destroyed to be able to protect pricing. So
Yeah,
It definitely needs to be taken into
I
consideration.
totally agree, David. I totally agree with you. Certainly, people have been able to buy assets for pennies on the dollar, but in order to do that, you have to think about so let's say a service company ABC owns 10 rigs and they have $100 million of debt. The only way that they sell those 10 rigs, which are the only way they can generate revenue, is they have to go through bankruptcy, which means that $100 million of debt gets converted into $100 million of equity. But the debt holders are now all the equity holders. So are the equity holders going to sell the rigs for 3 cents on the dollar? No. They're going to either try to run it or they're going to merge with another company. And if you're Halliburton, do you really want more rigs out there? If you're Precision, no. So Precision would use their equity to buy this company, and then they would destroy all the rigs, so that there would be no rigs that anyone else could come. So the strong guys will use this opportunity to use their shares and buy out the little guys after they've converted through bankruptcy and they don't pick up any debt. And then they will take a welding torch and they will destroy all that equipment so that there is no longer the surplus that we used to have. That's what I would do. That's what I would do.
I think there's a lot of people that are going to take your advice on that one. All right. So I know y'all are not here to watch me or hear me ask a whole bunch of goofy questions and stuff. Today is all about you guys being able to ask your questions. So what we're going to do is I'm going to turn it over to David, let him start, doing his presentation, his class time. If you guys have questions, please feel free to throw them into the comment section. We're going to get to I know that today is going to be just a super, super, super active day. So we're going to try to get to as many of them as we can. Please, tag a friend, share this on LinkedIn or YouTube. Let's get a couple more people in here watching. And then as we get to the stopping points, David will cue me. We'll get to a stopping point, and then we'll fire off a handful of questions. We'll go back to the lesson. You guys have watched this before. You know what the deal is. And then at the end, long as the battery doesn't die, we will Q&A as many of these until David taps out and says, I've got no more in me, and the hot take has become the cold take of the day. All right?
Thanks, David.
Sorry. No worries. I'm going to turn it over to you, sir, and then just cue me up for any of the website stuff like we talked about earlier. I can't even see my mouse. There's so much glare out here. There we go. I'm off.
What is going on, everyone? Thanks for tuning in. I get asked a lot, what would I have done if I hadn't ended up in oil and gas? And so that would go back 20 years. I think realistically, I probably would have wanted to be a university professor. I really enjoy teaching. One of the reasons I have the hot take of the day is because I really enjoy interacting with people. I enjoy giving speeches. I enjoy answering questions. And quite honestly, I feel very, very blessed with what happened with One Energy. And I feel like a big part of my role now is to give back. And I know that can sound a little bit trite, and I don't mean it to sound trite. As much of success is timing as it is skill. And when we started One Energy Partners in 2016, it was January 2016, and we sold it in the end of 2018 was the last part. In the last 6 years, we have been in an oil and gas bear market since 2014, and the only 2.5-year window that actually existed to buy assets, have oil rebound to $73 and be able to sell an asset happened to be that exact 2.5-year window. So I feel very blessed. The hot take of the day is really about teaching employees, teaching investors, teaching people about things outside of their silo that they may not have seen. And I know with 100% certainty, the reason I had success in my career was because I knew all the silos. I took an MBA, but I would not say it was the MBA that was the differentiator. The MBA just opened my eyes to a little bit more detail, and it was a tour of the library. And so you don't need an MBA to go into the library and get out books. Today, we're going to focus on financial statements. We're going to do it in about a 35, 40-minute class so that everyone can raise their level of financial literacy so that never again do they need to listen to the senior management of a company giving an investor presentation, telling you how great things are and pushing stats to you that don't have any linking to reality. And then you buy the stock and then you find out their stock went down 50%. And you're like, how did that happen? And at the core, it's because of balance sheets. It's because of income statements. It's because of cash flow. So we're going to go through those today. Nothing I say is investment advice, just as a little disclaimer. And I'll add, if you read the first page of any investor presentation, read the first page word for word, which is the forward-looking disclaimer. And you will understand why you too should never, ever look at an investor presentation, because it is all BS. It truly is. You cherry pick all the data, you do whatever you want. Financial statements are one of the favorite things I learned in my MBA. And the reason is because it's numbers, it's data, and it balances. But we're going to do an exercise here. So stick with me for 1 second. The video will explain it. But I want you to count the number of passes of the basketball by the white team. So give me a second here. And where are we?
It'll come up in just a sec. As soon as it pops up on my side, I'll put it up on the screen. There it is.
Perfect. There you go. Ready? Here we go. Here's the exercise.
Count how many times the players wearing white pass the basketball. How many passes did you count?
Okay. So, David, are you able to put up a poll? Okay. Don't worry about it. If you counted 15 passes, you are correct. So I congratulate you. But I want to know, how many of you saw the gorilla? Open question. For those in the comments, if you didn't see the gorilla, say, what are you talking about? I didn't see a gorilla. You can comment on that. Okay.
All right, I'm getting in here. I'm about to see, because we've got. All right, we've got one person that says, sorry, I don't even have my microphone over here. Sorry, guys. I was like straight away.
You stay on, David. I'm going to share this again. And I'm going to tell you that you may not have noticed, but there was a gorilla.
We've got Glenn that says, I think he got the ticker for Weatherford wrong. Oh, sorry. Hold on. Add to stream. There we go. Damn it.
Here he comes. See that? Okay.
Daniel Cole did not see it. Chris Schultz did not see it.
So the point of that exercise is, like if you're a management team, if you are looking for something and not paying attention to the broader thematic, you're going to miss the gorilla more times than not. And so the investor presentations that they build are about the white shirts and the basketball. And it's all their best wells, and it's all their best spacing, and it's all their best economics, and it's all their best drilling costs. And their team is so smart and so creative, and they have the greatest ESG in the entire world. But the gorilla in the room is that in oil and gas, the only thing that matters is the macro backdrop, and everyone forgot about the macro backdrop. And so the financial statements allow you to focus on the gorilla without being distracted by what the management teams are telling you, because you just can't lie in financial statements. So there's a couple concepts that, if you have a pen and paper, you might want to write these down. And we're going to go through financial statements. We're going to go through two financial statements today. The first is Chesapeake Energy. They're relevant simply because they went bankrupt. And so, I mean, it was very obvious. I did a hot take of the day, Technical Tuesday in February. I gave speeches in Oklahoma last year. There was no other way that Chesapeake could go. So if you haven't read that hot take of the day from February, you can go to my website and you can just search Chesapeake and go look at that one. And then I did a two-parter on Antero Resources. And Antero Resources is the example of why you need to read the financial notes that accompany the financial statements, because there is a lot in the financial statements themselves that are not included, and you need to read the notes to be able to understand what's going on. So that's the course. Go ahead, David.
I was going to say which one, because I just posted in the comment section, guys. I posted the link to the Technical Tuesday with Chesapeake, and then I can also post the one to Antero as well here.
Perfect. So you'll have those, and then if you would link the Chesapeake financial statements I had, you can follow along, or you can look at them after. We're going to do a screen share, and I'll sort of voice over it. But the concepts that I want you to think about right now are threefold. So the balance sheet, and let's see if I'll pull up my my little slideshow here if I can. Share screen.
And for all you guys that are watching on YouTube, I will get this loaded up on there as well.
So
All
hopefully,
right,
hopefully you can see that and you can hear me.
Yes, you're
Wonderful.
good.
Okay, so financial statements, there's 4 things we're going to talk about today. We've touched on them. The balance sheet is a snapshot in time. And so the reason that it says balance sheet at December 31st, 2019, or balance sheet at September 30th, 2019, at the end of a quarter, is because they take a snapshot of the financial position of the company on that day. So it's more of a stock. Where are we? Okay. So the balance sheet is composed of assets, liabilities, and shareholders' equity. And as you would expect, when it says balance, everything has to balance. And so the assets are equal to the liabilities plus the shareholder equity. Okay. And so in the most simple example I can come up with, if I have a company that I borrow $100 from the bank, my liability is $100. My asset is $100. So the asset equals the liability. Now, if I went out to shareholders and I raised $100 from shareholders, then my shareholder equity would be $100 and my cash would be $200. So the assets, $200 of cash, equal the liabilities, which are $100 of bank debt plus $100 of shareholder equity. Now, that tells you nothing about my business. It tells you nothing about my profitability, but it tells you the snapshot of what I have today. The income statement ties to the balance sheet because the income statement covers the activity between January 1st, as an example, first day of the quarter, and March 31st, the last day of the quarter. So it is the flow, and from the income statement is where excess income ends up translating into more cash, more assets, more liabilities. And so it shows up on the balance sheet. But the true reconciliation and the most important piece of the financial statements are the cash flow statements. And so cash flow, and so this is the key equation at the bottom that you might want to write down. It's very important. Cash flow from operations plus the cash flow from your investments plus the cash flow from financing equals the change in your cash position from period A to period B. And so when you reconcile all of these cash events, that's how you figure out what financial state the company's in. And like I said before I shared the screen, the single most important part of a financial statement are the notes, because one number in the balance sheet or in the income statement or in the cash flow statement can be represented by hundreds of assumptions. And anytime you make an assumption, you need to talk about it in the financial notes. That's the important thing we're going to talk about with Antero. So I'll stop there for 1 second, David. And if there are any questions about the mechanics that we want to talk to, let me know if there's any questions. Otherwise, we'll move on to example number 1, Chesapeake.
We've gotten a lot of questions in, but like the comment section, thank you guys all. I appreciate it very much. There's a lot of conversation going on in the comment section with guys kind of going back and forth. Somebody talking about a gorilla sneaking up behind me, but we don't have any as of right now as far as the mechanics and stuff. Guys, we do have essentially about a 30-second delay, maybe longer depending on where you're at. So if you guys do have questions, please fire them off, or if we do ask for questions, I'll try to pause, talk for a second, and then give you guys time to be able to throw out those questions. But keep them coming in. I'm trying to keep a tally here on the side so that when we do get to something, we can. So we did get one. It says, talk about goodwill from Brian Dugas. Brian.
Okay. Okay. So goodwill is typically, and there's always, it depends. So I'm going to say that. But goodwill typically is the difference between the price that you paid for something and the price that they had on the balance sheet. So let's use a hypothetical example. I'll use Halliburton just because it makes sense. But let's say Halliburton goes and buys service company ABC, and they pay $1 billion. But the value of their balance sheet had only 100 million of assets, because a whole bunch of it was intangible customer relationships and all these other things that you can't quantify on a balance sheet, because we're going to talk about the balance sheet here in a second. But the balance sheet does not reflect value at all. The balance sheet simply reflects the amount of cash that was invested into the business and the amount of depreciation that has occurred on that cash. So in this hypothetical example where Halliburton bought a company for $1 billion, but there was only 100 million of tangible assets, they would also include, since they paid the cash, presumably, they would also include a $900 million goodwill asset that would be on the balance sheet. And periodically, they would test the goodwill to be able to see, will this goodwill translate into true value, or do I need to write it off? So goodwill simply represents the overpay of something that you bought for intangible value, and it doesn't have any real value. So I assume you're talking about like a Baker Hughes or a Weatherford or one of these major service companies that have done a big acquisition that had a lot of goodwill on the balance sheet. Goodwill would typically be more from like a financial company. Like I think we saw that Amazon bought a small startup the other day, and that the balance sheet of that company probably had $100 million of assets and they paid $1 billion. So in tech, there's a lot more intangible. So goodwill is a much, much larger portion of that than it is in oil and gas. So again, there's nuances to that, and a pure accountant would be able to dive in and say there's a whole bunch of reasons that that's different. But broadly speaking, that's the definition and reason why goodwill would exist. And it's kind of a phantom number on a balance sheet that doesn't mean anything. Helpful?
All right.
Okay.
Yeah. So we got one more, which is Saeed said, how do you raise equity?
So raising equity in the public markets is interesting. Actually, raising equity anytime is interesting. But effectively, you're using presumably bankers and going out and going on the road to show your business model, and then meeting with potential investors who would invest at-risk capital in your business. And so at-risk capital obviously is shares, and they would have different classes of shares. There can be common equity, which is what mostly is traded on the stock exchange. And there's preferred equity, which has slightly higher in the capital structure, but still lower than debt. And so raising equity is sort of a process where you go out to the market, you see if you can raise, you price your shares, and then you bring it in. Now, the thing you're going to hear is in oil and gas, the equity markets are dead. There are no public investors that have any interest in investing new cash into a business for a lot of reasons. There's a big movement of a divest fossil fuels. The core reason is because 100% of oil and gas companies are publicly traded, and they are trading 50 to 100% above the level they should. And so use Chesapeake. Chesapeake was trading at a non-zero value, even though everyone knew they were going bankrupt. They declared bankruptcy, and their equity was totally wiped out, and now they are worth zero. And so equity holders don't want to get caught holding the bag. So right now in oil and gas, there is zero ability to raise money in equity. And even debt, unless you're Exxon or someone absolutely massive, debt is extremely hard to come by. Hence why there's just not a lot going on in oil and gas, if that makes sense. Okay, so I'm going to share Chesapeake, and for those who let's just go back. The SEC, which is the Securities and Exchange Commission in the United States, requires that every company file financial statements quarterly and then files a financial statement annually. So the most robust financial statement that has the most level of information is called a 10K. And every year a company will report their 10K. Now their quarterly is called their 10Q. And so you can go to any public company's website and look under investor relations and SEC filings, and you will find their balance sheets. They are required to be published. They are audited, and all of the information that you need to know about the operations of a company exists in this document. Now, there's a lot of nuance like goodwill that you need to understand. But what we're going to do is we're going to quickly whip through Chesapeake, and you're going to see the problem, and you're going to see why they went bankrupt. So if everyone can see that, David, give me a yes if you can see what I'm looking at. I'm looking at the consolidated balance sheet compared to 2019, 2018, and we're looking starting at current assets.
Yes. So I'll drop the link in the comment section again for you guys.
Awesome. So I mean, every balance sheet has some variation of this, and so we're going to go through what it means. Current assets are things that are quickly convertible into cash or some level of something like cash. So at December 31st, 2019, Chesapeake had $6 million of cash, $990 million of accounts receivable, which typically would be like JIB payments from other partners or revenue that hasn't been received in cash, but has been produced and therefore accrued. And so there's a concept in accounting called accruals. And accruals are, if I know you owe me $100, even if I don't have the $100 today, I accrue $100 into my income statement and balance sheets because I know that you will pay it. When the cash comes in, I record the conversion, but I don't record it as new revenue. So accounts receivable reflect all of the cash that I'll get probably in the next year, most likely in the next 3 months, but the definition of short-term is year. Then there's short-term derivative assets, which would be, again, settling hedges predominantly, and then other assets, which can be tax benefits, et cetera, et cetera. Usually these are in the financial notes. So their current assets are $1.25 billion. You can compare that to 2018, and you can see that they've dropped their current assets by about $350 million. Okay,
David, real quick, can you hit the zoom button there to make that a little bit bigger?
Absolutely.
Let's see.
How's that?
I think that was good. I think it might be good enough. Maybe hit it one more time just for everybody that's out there watching, because someone might be watching on mobile platforms where it's a little bit harder to see.
Good.
Hopefully.
So then the second piece is property and equipment. And this is a really important one for oil and gas. So over the course of Chesapeake's history, of the assets that they have, they spent $30.765 billion on proved assets. So something that is reflected in their proved reserve report. That would be the total amount of dollars that they had spent since the beginning of the company. They have another $2.17 billion that are attributable to properties that aren't proven yet, but still have some value. So to the question on goodwill, this is sort of the goodwill. And then other property and equipment, again, it's in the financial notes as to exactly what this is, but that's $1.8 billion. So what this line tells you is that Chesapeake, since the beginning of time, of the assets that they haven't sold but that they did buy, has spent $34.748 billion on assets. Now, the depreciation is it's a non-cash item. But if you think about reserves, if I have 100 barrels of reserves and this year I produce 40 barrels of them, I would depreciate 40% of the cost of the 100 barrels in that year. So the accumulated depreciation of that $34 billion is $20 billion, which means that the net invested capital, net of depreciation of Chesapeake, is $14.756 billion. Does that make sense to everybody? So I'll just say it one more time. They spent, this only reflects dollars that were spent, not the value of the reserves. Chesapeake spent $34.7 billion on assets, and they have depreciated $20 billion of assets. So the net result is that they have spent $14.7 billion of assets, which means that the total assets of the company, including cash, accounts receivable, other derivatives, and the dollar value they spent, the assets are $16.2 billion. Now, that has nothing to do with the value of the company. That has to do with the amount of historical spend. That's all a balance sheet does. Okay? Now, we're going to skip to the liabilities, because the liabilities, as I said, are the opposite to the assets. And so the equation is assets equal liabilities plus shareholder equities. Isn't school fun? Aren't you glad you're tuning in for this? Okay. So
you're the best teacher I've ever had.
Similar to assets, we have current liabilities. So accounts payable are the offset of accounts receivable. These are things that Chesapeake has committed to pay for, but has not yet sent. Current maturities. This is the most important item for oil and gas companies right now. Current maturities are when you owe debt back to people. And debt, remember, you have to pay debt back. You don't have to pay common equity back. So anything that comes mature, which means it's due in the next 12 months, has to be included in your current maturities of long-term debt, which means that in 2020, Chesapeake must pay $385 million to their creditors to close those bonds. That is typically the event that creates the conversion of a company into bankruptcy. When, let's say that the bond was due June 1st, they didn't have $385 million. They only had $6 million in cash, and they couldn't borrow it from anybody else. So they tell their creditors, hey, I know I'm supposed to pay you $385 million today, but I can't. So I know I'm in default, but I need an extra week. So sometimes you'll see a press release that says, and Lilith Energy is a good example of this, they had an extension of their deficiency week after week, month after month, until finally they declared bankruptcy this week. But it's basically like, please give me 7 more days. Don't break my knees. I'll go try and find money from somewhere else. Ultimately, when that doesn't happen, you go bankrupt. They have accrued interest. Again, you can read the financial notes as to what it is, and then other current liabilities. And this is usually when the balance sheets get exciting. Other current liabilities. So sometime in the next 12 months, I owe $1.4 billion. What does that mean? And so that's the first place in a financial statement you would really want to go figure out what the other current liabilities are. A great technique is to use the Control F button, which brings up your find, and you type other current liabilities, etc. And then you'll be able to scan through all the places where that appears. Here, here, here. There's my financial note. What is it? So it's revenues and royalties that are due, drilling costs that are due, joint interest that's due, VPPs that are due, compensation. Wow, that's a big number I've deferred. Taxes and other. That's a lot of current liabilities in the other liabilities, isn't it? That's why the financial notes are so important. Then we get to the category here. $9 billion of long-term debt. $9 billion. $9 billion. So remember that number. Total liabilities are 9.4. If you remember, the assets were worth about 16.1. And so by definition, when you look at the difference between the two, there's your shareholder equity. 9.4 plus 4.4 plus your preferred stock here equals 16.193. So the balance sheet works because it's balanced. But again, this is not the value of the shares. As you know, the value of the shares is zero. So what happened to that $4.3 billion of equity and that $1.6 billion? Well, this is what happened. So now we go to the next statement, which is the consolidated statement of operations. I'm actually going to do a relocation here so that you don't have to hear the lawnmower if that's going in the background. So I'm going to go inside. Stick with me.
No worries, David. Take your time.
Here we go.
I will say this.
We're on the move.
While you're moving, we did have a couple of questions that came up. And I want to give a shout out to these guys. So the guys over at Mineral Answers on YouTube said, David, on accrual, how can you discount the risk of non-payment? So what if what's owed isn't paid?
So good question. I'm here. Now I'm coming back on camera.
Hey, as long as your battery doesn't die.
Yeah, exactly. So again, everything in a financial statement does not include an estimate of if you don't get paid. When you make the election that you won't get paid, you would include an item in your income statement that would be called bad debt. And so if you were supposed to be paid $100 million and you didn't get paid and now they went bankrupt, so you know you won't get paid, you would take a $100 million charge, which would then offset that accrual, and it would go into your income statement as a loss. And then that loss would be write-offable from tax. But you don't, in terms of the accruals, you accrue to the number that is owed. You don't accrue to the number that you expect you're going to get. Does that make sense?
Excellent.
Okay.
I do have one question though, because one of the numbers in there that was really high was the amount owed to royalty owners.
Yes.
So we've talked about, like, you know, there's debt, there's preferred stock, there's common stock. Where do the royalty owners stack up in that category?
So the royalty owners are the highest claim on the company because that is like it is a revenue. And so typically, like, for example, oil is paid 2 months after it's produced and gas is paid 3 months after it's produced. And so what would happen is that number represents 2 months worth of production that Chesapeake produced the barrels, hasn't received revenue for those barrels, therefore has owed royalties on that last 2 months that will be sent out as soon as they get the check from the royalty, from the purchaser of the crude, if that makes sense. So because so then that ties to this. The total revenues of Chesapeake are $8.5 billion. And so, you know, when you think about that's probably $2.5 to $3 billion a year, which is around $250 million a month of royalties that they pay. So the number is large out of context, but in context of how big the revenues are, it's really not that big, if that makes sense, David.
Fair enough.
But the mineral owners, the royalty owners, always get paid first. And so they're the highest claim above even the creditors.
Excellent. So could that be used as a way to be able to determine what their average royalty interest is? Look at what they're owed for the past 3 months and what their royalty or what the revenue was?
It depends, but I'm going to show you an item in that you can hide things. So yes, but generally speaking, you know, it's a 20 to 25% royalty. So broadly speaking, you would just use that as an estimate. But that would be one way you could back into it. But again, it's just imperfect information. So it's really, really hard to figure out what the company's net interest is. That might be the one thing you might look at in an investor presentation, is companies are generally pretty accurate on, you know, our net royalty interest is 78%. That's probably pretty accurate.
All right, guys, I'll stop asking questions. I'll let you go.
Okay, excellent. So let's turn to the income statement. So the income statement, as I said, is a flow, not a stock. So in 2019, Chesapeake generated $4.5 billion of revenue from oil, natural gas, and NGL sales. Now, this is a really interesting line. This is marketing. And so there's a lot that goes into marketing. And again, I'd encourage you to read the financial statements. But marketing might be Chesapeake's own internal marketing department that's owned by Chesapeake Parent that has a sister company that's Chesapeake Producing. They might buy all of the product at a set price, and then they might resell it. And so this $3.9 billion that makes it look like the revenues of Chesapeake are $8.5 billion. The interesting thing is when you look at this marketing number here, look at the marketing on the operating expenses. So the marketing was they generated revenue of $3.9 billion and they generated costs of $4 billion, which means they lost roughly $30 million, $35 million in their marketing endeavors. And those two numbers net each other out. So again, it's just sort of it's interesting, but if you're looking at gross profit margin, you have to really consider what those revenues are and what they mean. So you can see the revenues in 2019 were 8.5, down from 10.3. And remember, they also bought Wild Horse. And so when they included Wild Horse operations from the day they closed, you can see the change in price from 2018 to 2019. That's really significant. In terms of operating expenses, again, year over year, operating costs went up, their transport went down, severance went up, marketing went down, G&A went down. So you can see these comparisons, but these are all the expenses, including that non-cash charge we talked about from the balance sheet, the depreciation. So they depreciated of the $34 billion original cost. They depreciated an additional $2.26 billion this year. And so your total operating expenses, cash and non-cash, were $8.6 billion as compared to the revenue, which was $8.595. And so I'm sure that you noticed that that means that the operations actually generated a loss. Does that make sense to everybody?
Think so.
Okay. Now, we haven't even talked about the financial. Remember, they owed $9.4 billion? Well, that $9.4 billion ends up getting $651 million of interest per year. Then they wrote off $71 million on investments. They exchanged some expensive debt for cheaper debt, and they recorded a non-cash gain, and then they got other income. So when you combine the interest expense with the operating expense, so I take it from a cash flow. When you think about it, there's the cash flow from the operations, but then there's cash flows from financing. And so the financing has a charge, and that's never included in the cash flow from operations. So when a company says we're doing great, our cash flow from operations is high, they're excluding a lot of the times the interest. And it's this interest expense that is absolutely killing them. So they had a $640 million loss. They had a deferred income tax loss of another $305 million. So net available to common stockholders, they recorded a $416 million loss. What does that even mean? Well, that's where the cash flow statement is the most important part. So unless David, and I'll pause for a second unless there's any questions on the income statement. The income statement is interesting, but it's only interesting because it ties to the cash flow statement, and the cash flow statement is far more important than the income statement.
We haven't really gotten any questions specifically on this portion. We've gotten some other peripheral stuff that I'll save for later.
Okay, great.
We'll just save this for a little bit later on.
This is the last piece as we talk about the financial statements, and then we're going to do a 5-minute discussion of Antero and why the financial notes matter, and then I'll open it up to questions. But in terms of this piece, so remember that the loss was $308 million. Now, cash flow reconciliation from operations is you add back all of the non-cash things. So I had a $308 million loss, depreciation non-cash, so you add it. The deferred income tax expense, I'm not actually getting paid from the government. This is just an accounting reconciliation. It went down 305. Then I had this $3 million cash payments on the settlement of derivatives. That doesn't count because it's a non-cash relative to operations. So it's included in my revenue, which if you go back to the income statement, of course, back here, your revenue net of your expenses equal your net income. And so if my revenue already included a gain, I have to deduct that gain from my cash flow. So it's a non-cash gain. Then stock-based compensation, sales, et cetera, the change in accounts receivable, the change in accounts payable. And what I end up with is in 2019, Chesapeake had $1.6 billion of operating cash flow. Now, remember, they had $9.4 billion of debt that they must pay back. 1.6 billion in operating cash flow, 9.4 owed. So even if they spent zero capital and were able to keep production constant, which we know is not true, it would have taken them 6 years to pay down their debt with the operating cash flow they have. And so clearly you can see, since they had more than 6 times debt to operating cash flow, their company was destined to fail. And it was not a question of if, it was a question of when they went bankrupt. Now, there are a lot of companies that went into 2020 with 2.5 times. So the comparison would be, if you had 1.6 billion in cash flow, you might have $4 billion of debt. Well, with prices, it probably means you have $1 billion of cash flow and $4 billion of debt, which means that you are inevitably going to go bankrupt. And so all of the people that came into this year north of 2.5 times debt to cash flow are basically living on borrowed time, and their equity value will go to zero. Again, I'm not telling you when, I'm just telling you that's likely to happen. It's not investment advice, but that's why owning oil and gas stocks right now is almost impossible. So second piece of cash flow, now that we've talked about operations, is the cash flow from investing. So these are the activities a company does to invest in the asset, which primarily is drilling and completion. They spent $353 million to buy Wildhorse. They bought $35 million of unproved properties. They divested 130 of proved. And so they spent $2.4 billion running their business, and they had cash flow of 1.6 billion. Just as a rhetorical question, does that seem like a good business when you think about 2019 prices averaged $20 a barrel higher than it does right now, and they spent $800 million more drilling and completing wells than they did from their cash flow? I hope you know the answer to that is no.
I can at least get that one right.
Okay. And then the final piece, and so this is interesting, this is cash flow from financing. So this is, how did they pay for that $800 million? Because remember that the equation is cash flow from operations plus cash flow from investing plus cash flows from financing equal the change in cash. We know from the balance sheet they had $6 million. The change in cash in 2019 was $2 million. So we know that the sum of cash flow from operations plus investing plus financing had to equal $2 million to equal that change in cash. And so what you saw is they took $10.6 billion of debt new. They paid off $10.2 billion of debt old. They issued a new $1.4 billion. They paid back some old debt, and they ended up, net of that, raising $859 million of new debt that now in bankruptcy will likely not get all of it back. In fact, it probably gets 30 cents on the dollar. So that is how a financial statement comes together and why the numbers matter. So I'm going to take a break from that. And then if there's any specific questions on Chesapeake, please ask those now. I'm going to pivot to Antero, and then we're going to end and take questions. Okay.
We did get somebody to ask. They said, can we do Oxy next?
Yeah. Again, it's a long, you can do Oxy for yourself. I can certainly comment on Oxy at the end of this. The thing about Chesapeake was in financial distress for the last 5 years, and certainly for the last 3 years. And so the thing, as you'll remember, that brings a company to bankruptcy is when the debt comes due. And so Chesapeake had $385 million they had to pay back. They had only $6 million of cash. They were overspending their cash flow from operations and investing, and no new debt was going to give them money. As a result, they had to declare bankruptcy. The difference is Oxy just got the debt last year. Much of the term of that debt is very, very long. So they have 5 years to figure it out. And there's a lot of tools in the tool shed to be able to manage debt. So that's the difference between the timing of a Chesapeake and an Oxy. Okay. Now, the last thing I want to talk about with Antero is financial statement.
Oh wait, hold on. We do have a couple of questions coming in there to this. So here we go. So in this condition not created, is this condition not created because of cheap money? Interest rates are low, which creates the perpetual borrowing machine.
That for sure. If you look at the origins of the 2014 bust, the origins were in 2008, the world thought they were short of oil and the shale gas had busted. And more importantly, the money machine that was being run out of New York that was lending money through houses ended. And banks had nowhere that they could put money. And the only business that had a real business back then was oil at $80 in 2009. And so you could loan money at the same time as the Bakken and the Eagleford were effectively discovered. And you could loan massive amounts of money to oil and gas companies in the high yield market, generate massive fees, and nothing else was working. So from 2009 to 2014, companies borrowed money at an ungodly clip because exactly that, interest rates were low. And they built their business for $100 oil. So guys like Oasis went in the Bakken and bought assets that don't work below $100. Guys like Whiting were buying assets in the Bakken that don't work below $100. So companies until 2014, if everyone remembers, if you were working there, the price deck we ran in 2014 was 90 flat forever. and $4.25 in MCF.
Oh my gosh.
Those were the price decks that were being run in every acquisition that was done in 2013 and 2014. Now, oil since 2014 has averaged around 55. So number one, companies, but the maturities, all the debt they borrowed in 2014 didn't come due until 2019. And in 2019, things looked good. So guys kept loaning new money to these companies instead of forcing them into bankruptcy. And now when COVID hit, everyone had enough and said, we're not putting another dollar into this because you're technically insolvent. And so that's how the money machine ended. That's how the money machine started. Companies had an opportunity post 2016 to not grow production. They could have paid down their debt. Therefore, service companies wouldn't have ramped up their scale. Therefore, everyone wouldn't have been leaning in saying, please, God, let there be another boom. I promise I won't blow it this time, but I have to grow my way out of debt because if I don't grow my way out of debt, I'm going to go bankrupt. And so, unfortunately, COVID hit and everyone's going to declare bankruptcy. Not everyone, but probably 50% of the companies will declare bankruptcy in the next 6 to 12 months. And if they don't declare bankruptcy because they're not technically insolvent because their debt doesn't come due until 2022, they won't have any access to capital. So they won't be able to drill, which is why rigs won't come back up. Frac spreads won't come back up. Companies won't buy things and there won't be another resurgence because oil is 40 and nothing is economic at 40. So that's the answer to that question.
I would just like to say, I think it'd be really interesting if through all the acquisitions, you could, if it was publicly available, to see what the price deck was for each one of those acquisitions.
Yeah, it's not available. And certainly it's one of the things that hurt Oxy, but it's also, everyone forgets April 12th of 2019 was the day that Oxy overbid Chevron. Chevron bid $65 a share, and Anadarko, because of their midstream, had a huge amount of debt. And so we always talk about this $55 billion Anadarko acquisition, but like over half of it was debt. So Chevron was going to get just as much debt too, and Chevron thought it was a good idea. Oxy paid more, $75 a share, which is a 15% overpay, which we can talk about in the questions. It's not that much. but oil was $73 a barrel the day that transaction was announced. And it looked like there was no reason for oil to trade below 65. And so at 65, the world looks very different than 40, obviously. That's why you hedge. But anyway, so any other questions on Chesapeake? Otherwise, I want to talk about Antero, and then we can open it up to broader questions.
Yeah, maybe not Chesapeake specifically, but we did get, if you could, oh wait, I clicked on the wrong one. Sorry, Travis, I was going to get to yours in a minute, but could you please state clear the difference between income statement and cash flow statement? So this kind of goes back to what you were just talking about.
The income statement is a reconciliation of revenues and expenses, and the expenses are both cash and non-cash. The cash flow statement is the reconciliation of the actual cash. So depreciation is not a check you have to write, therefore it's non-cash. So it shows up on the income statement as a deduction because it's a deduction of the amount you spent historically. But on the cash flow statement, it gets reversed because the depreciation is irrelevant. I can depreciate my house $300,000 today for tax purposes, but I don't have to write it yet $300,000. That's the difference between.
All right. I think that's all we got for Chesapeake. We've got some other questions, guys. Please, I'm not abandoning your questions. We're just trying to stay with kind of the flow of what we've got going because we're getting a lot of really good questions, David. Kind of different things about Weatherford, other companies.
So we'll take all those. I want to talk about Antero because if you didn't believe how important the financial statements, the financial notes were before what I'm about to say, you're definitely going to believe it after. And so you can read the hot take of the day where I did a 2-part murder mystery on Antero, and I turned it into someone who was murdered. And the question was, did the debt do it? Did the firm transport do it, or did the commitments do it? And it was one of the 3 children that will murder Antero. It was just a question of which one. So it was a fun one to write. You can check that one out. But the key here, so let me share my screen again.
All right.
In Chrome tab. And
thank you all you guys for watching out there and taking part in this. We really do appreciate it. We're getting tons of really, really, really great questions. Feel free to tag your friend in the comments so that everybody else can, enjoy and take part in this amazing discussion that really affects all of us.
So the thing that is there are a lot of people who are bullish natural gas. Now, I am bullish natural gas as I am bullish oil long term.
Can you zoom in on this one too, David, please?
Sorry, what was that?
Can you zoom in on this one too?
Oh, yes, of course. There we go. Okay.
There we go. Thank you.
So the reason natural gas players have a problem is unlike oil that you can put on trucks, you don't need long-term obligations. But for gas, especially in the Appalachian region, if you remember, in 2010, the Appalachian region was producing about a BCF a day. Now it produces over 30 BCF a day. And to move gas, you need pipe. And the brilliance of the midstream business in a growth market was they could make companies pay for 10 years of firm transport just to get them to build the pipe and guarantee their returns. That was why they could borrow so much money and build this massive infrastructure on cheap debt that traded at astronomical prices. And it was why the private equity companies and why the public companies were constantly trying to spin their midstream out. Because an E&P company might have 6 times debt, 6 times cash flow to EV multiple. A midstream company might get 10 to 12. So the financial engineering of midstream is incredible. And so when you look at a company like Antero, what does not show up on the balance sheet or in the income statement are the future obligations of the company for firm transport. And so when you look at an Antero who has like a $2.5 billion market cap and they have I can't remember the number. It's like $10 billion of debt, something like that. Maybe $5 billion. Anyway, you can check it. The most important piece is every year they have an obligation of $1.1 billion of firm transport, 55 million of processing, and 300 million of operating and financial leases that they've done to put their compressors, etc., off balance sheet, which means that their total off balance sheet transactions that they did are $18.3 billion between now and the end of the company. And their equity trades at like 2-ish. So the obligations they owe are 9 times the equity, which is why next year Antero was going to have to pay for 2020 for unused firm transport $450 million to fill unused pipe space. And for the company, it cost them $1.94 in taxes and firm transport per MCF before they produce a single MCF, and gas prices are $1.60. And so the problem of gas is that Antero, it's more economic for them to keep drilling at a loss than it is for them to decline volumes and have to pay more of this share as cash. Now, they've done some restructuring of some of their firm transports and changed some things around in 2020. But at the core, this is why financial notes are so important, because this doesn't show up on the balance sheet. This doesn't show up in the income statements. This doesn't show up in the cash flow statement. But this is a real obligation that when people tell you that Antero is in trouble, this is the reason why. Now, will they be able to manage this out? And was their hedging for the next 2 years going to support it? For sure. But without that hedging, they can't drill. So they better get in place some hedges for 22, 23, 24, 25 to justify drilling, because all of this cash is coming due at some point. So that's why I really encourage everyone, if you're going to be an investor, you have to read the 10K cover to cover. You need to read every single financial note. You need to tie it out, and you need to understand what you're buying, because a lot of people in Robinhood land went and bought Chesapeake stock in the last 2 months. And if you bought Chesapeake stock and you put $1,000 in, it is worth $0. And if you thought you were going to pay for your retirement with $50,000 of Chesapeake stock because Robinhood was making it double and triple and quadruple, it was technically $0 for a very, very, very long time. And so that's why I'm personally short oil and gas, is because the fundamental value of these companies, which you can see in their standardized measure of oil and gas, which is also in the 10K. And that'll be the last thing I talk about, David, because I haven't talked about it. I just want to show people how easy this is. So I'm going to share the screen.
Okay.
Share my Chesapeake. I'm going to go to this. So check this out. You ready? You say, I don't know how to value companies, David. You go Control F. You type in standardized measure. You find it. And you find this table right here. Where are you? Boom. Standardized measure of oil and gas. $9 billion. Do you remember when I said that Chesapeake owed $9.4 billion of debt? The PV10 of their asset at $55 flat and $258 right there. You run that price deck forever. You drill 5 years worth of wells, assuming you can finance them. You cash flow out all your wells for the history of ever at a price deck that is $16 a barrel higher than today and $1 an MCF higher than today. And at that, they have a $9 billion PV10. 9 minus 9.4 equals negative 400 million. How were the equity holders ever going to get their money back? They never were. And when you look at the standardized measure of every company in oil and gas, you can see where their debt is, where their assets are at $55, because the SEC mandates that every company use this price for the rest of time. Next year, this price is going to be 30, and I suggest that this number would look more like 3. So that's why I'm short energy. That's why I cannot own oil and gas stocks other than the one that I unfortunately still have, because I missed COVID and I missed the price change. So that is the course. I hope it was useful, and I will take as many questions as we can.
All right. So Martin Parker.
On the move.
All right. Just don't let your battery die. Just don't do that one too.
We got lots of battery.
All right, so Martin Parker. Martin has been a huge help for this show. He helped me set up with Steve Noss and with last week Calvin Holt. So he's one of the managed pressure drilling guys. But big thanks to Pruitt and those guys over there. And Martin, thanks for watching the show. He says, "How does Weatherford carry on surviving?"
So I'm going to answer it generically because honestly, I don't follow Weatherford very closely. But here's the deal, and here's why the market is broken, and here's why all the people that come out and tell you that they have a great business plan that's going to work, hope is not a plan. So the debt holders, hope is not a plan. The debt holders have some amount of debt at Weatherford, and once a company declares bankruptcy, the creditors now own it. There's really no liquid market for the debt. So before Extraction went bankrupt, their debt was trading at 7 cents on the dollar. So if I loaned Extraction 100 cents and they were paying me 6 cents a year, and they took that loan, I would have got 12 cents in interest payment. And before bankruptcy, for me to trade out my bonds, I was going to get 7 cents, which was a 93% loss. Now, the funny thing about bonds, you're not supposed to lose money. And when you only get a 4 or 5% interest rate as your coupon, and you lose 93% of your money, that equals no bueno. So Weatherford went out to their creditors and said, I want to borrow $1 billion here, $1 billion there, $1 billion here. They go through bankruptcy. And let's say, hypothetically, let's not talk about Weatherford specifically because I don't know the numbers, but let's say hypothetically, service company ABC has $10 billion of debt. They know they can't pay it back. So they go to their debt holders and they say, we want to restructure through Chapter 11. And the creditors say, okay. And then the board and the advisors, they all negotiate and they say, what we're going to do is we're going to take $8 billion of the debt and we're going to turn it into equity. And so, David and I own 25% each and Frank owns 10 and whatever. And so I'm going to end up with 25% of that $8 billion. And we're going to convert that into shares. And we're going to leave $2 billion of debt that you have to pay back on the balance sheet. I'm going to come public. And so instead of me having $10 billion of debt, post restructuring, I only have $2 billion of debt. And I converted that $8 billion of creditors into shareholders. So I don't have to pay them back, but hopefully the share price goes up. So then you do that. But then it turns out the business didn't actually get better, that I still can't pay the $2 billion of debt, because what they do through bankruptcy is they leave as much debt as humanly possible on, because the debt is the only thing you're going to get guaranteed to get paid back. So there's no incentive for them to wipe out all the debt. So they always leave a lot of debt. And then things don't get better. And then they have to declare bankruptcy again, because that $2 billion of debt just bankrupted the company. They wipe out the $8 billion of equity they just created, make that zero. They leave $1 billion of debt on the balance sheet, and now there's $1 billion of new equity. And maybe that company survives. But the problem is, until you go through those iterations, and because oil is 50 and no one's using drilling rigs and no one's using MWD and no one's using coil tubing and no one's using service rigs and no one's using frac, there is nobody buying it. So you can't get your money back unless you wait. So creditors are just converting into equity and seeing what happens by kicking the can down the road. That's why Weatherford doesn't die. But at some point, the service companies, and I would use Extraction as an example. I don't know any different. Extraction will be blown up. They will sell it. There won't be management. There won't be staff. They will sell it to a Noble or a PDC for shares post-bankruptcy, because they don't have the scale to compete in Colorado. And so eventually it'll go through bankruptcy. Creditors will get converted. And then the creditors will just say, whatever, take the keys. I don't care. I got good value. I took shares in company ABC, and that's how that is. So that's why Weatherford survives. But I think that game is up, and these companies will collapse, and be consolidated. And in service companies, they'll just blowtorch a lot of the equipment.
So what do you think about as far as, sorry guys, this is going to be my question. What do you think about as far as those management teams, right? Because like if the bank comes in and they take ownership of it, they've got to be able to put, board members or, executive level, C-level people in place. Are there any good ones left out there to be able to put in place to be able to manage these things?
I mean, so this is it's a bit of a rigged question. I'm going to use Whiting as an example. So Whiting went.
This does go to one of the questions that somebody asked about, CEOs taking $1 million worth of pay before going bankrupt. So,
okay,
just say we are acknowledging that question.
Yeah. Okay. So here's the deal: board of directors work for the shareholders, but they're generally put in place by the management team. So there's a reason that DRW, yours truly here, isn't on a lot of boards, because if I was in the boardroom, I would not be very fun to deal with if you bankrupted your company, and I'm probably not giving you $10 million like retention bonus. I'm probably firing your ass. So as a result, there's a lot of diversity now in the boardrooms because they've added members, but there's not a lot of intelligence in the boardroom. There's certainly not people who are willing to ruffle feathers. But the point of the board of directors is the board works for the shareholders, but they were handpicked by the management. And when the company goes bankrupt, the day they go bankrupt, the board actually works for the creditors. And the creditors have so much more money that they actually control things a lot more. So what you've been seeing is 3 or 4 days before a company goes bankrupt, the management team goes to their board and says, now that all our equity is worth zero, you want us to stay here because why would I want to stay at a company if I'm not being paid really well? How about you give us all retention bonuses for a year and change of control things and blah, blah, blah. And the board says, yeah, that's a really good idea because I know you ran this company into the ground and didn't make any changes when you could have, but I like you and I want to keep you there. So I'm going to give you that money. And then they declare bankruptcy, but the creditors have the opportunity to null and void that because the courts say anything done within 180 days of bankruptcy is not technically legal. So the creditors could unwind that if they wanted to, and then they could fire the whole management team and bring in new people. But they don't really do that. So the short answer to this is, unfortunately, the public markets are fairly corrupt in terms of what is happening for shareholders. And in a time frame like this, it's super unfortunate that boards continue to pay management teams that have driven down the value of a stock 100%. I don't get it. I don't invest in energy companies anymore. I buy the other side of the bet. I believe that energy companies will fall in value because of this. Therefore, I make money when shares go down. That's my answer to it.
All right. Now we'll start getting into some of the other. Sorry, guys, I asked the question, but it kind of preluded into somebody else's. So Travis Vistu. Travis, thanks for watching the show. He's a great drilling engineer. If you could name 3 oil and gas companies that would be best positioned to come out of the multi-year downturn, who would they be? Who would be your top 3 that actually make it through this?
Yeah, I was doing my best blank face. One LinkedIn user said, just mute your microphone with the wind, David, when...
Oh, okay. Yeah. Sorry, guys.
Oh, man. Okay, so again, this is not a buy recommendation. I need to be very clear on that because I think that shares continue to fall. EOG and Pioneer both have very good balance sheets because they never really use debt. And so they have 0.4, 0.5 times debt to EBITDA or cash flow from operations. And so the likelihood of them going bankrupt is extraordinarily low. Now, that being said, if you use the smog analysis that I talked to you about, at $55 flat, EOG is worth somewhere around 35 a share, and they trade at somewhere around 50. And Pioneer is worth 40 a share, and they trade somewhere around 93. And that's at a $55 price tag. Chevron and Exxon and Conoco have good balance sheets. But again, I can't value their refining business because I don't know what oil demand is going to do. Do I think they go away? No. Exxon clearly has access to the capital markets. They raised something like $10 billion during COVID at like 3%. So they can borrow money unlike everybody else. So they probably survive. But the key here in terms of the US, and it's why I say that oil investment in the United States is dead. Shale requires $50 to $60 a barrel to make an economic return. That's full cycle to drill a well. $50 to $60 a barrel. That's what it needs. Oil is 40. The forward strip, which is the market's best guess of what it's going to be, the forward strip for the next 5 years is 40. So if oil is 40 and a company needs 50 to get a 10% rate of return, every well they drill is value destructive and reduces their inventory. So therefore, the only thing an oil and gas company can do is shut down for 5 years and wait for declines to happen, demand to return, and prices to go higher. Which then says, if you're Saudi Arabia and you have your foot on the throat of the American producers and you produce 9 million barrels a day and you can produce 12 million barrels a day and you have a 53-year reserve life index when Exxon has 17, don't you want to raise your oil to 20 million barrels a day, given that there's a risk that now oil is not a legacy asset and the world switches from fossil fuels in the next 30 years? I think yes. And same with Russia, and same with Colombia, Libya, Nigeria, Iran, Iraq. And so under $50, I think these countries can economically grow their production more efficiently than the US. And so how do I bet on US E&P when I think that oil stays in a $40-ish range for a very long time and no oil can be drilled economically in the United States? So to me, the best investment is to be short energy companies. And if you don't want to be short, which is highly risky and I don't recommend it, just don't invest. Don't own it. Wait till oil's actually 50. Wait till bankruptcies have actually happened. Wait till companies trade down to their true value and then buy them then. But we're nowhere near that. And so that's my answer to that question.
Unmute. The next one. How do we need to push the paradigm shift for the investment world of oil and gas?
I mean, look, so I think the ESG thing was all bullshit. What happened was so again, I was giving speeches and at $55 flat, Concho was worth like $32 a share. Okay. At 40 flat, Concho's probably worth 15, maybe. I don't even know. They trade at 50. So if I'm meeting with a management team and I'm in charge of, Bank ABC's oil and gas investment committee, and I actually think the company's worth 15, because we're not Amazon. Like, we don't have an unlimited capacity. We have limited inventory. We have a price. We have a cost to drill, and you can run the model on the whole company. And so if I think Concho's worth 15 and Concho currently trades at 50, am I going to go in and meet with Concho and say, you're worth 15, you're an idiot? No, because if a war happens or if Concho goes to 70, my investment committee is going to fire me for looking like an idiot. So what do I say? I say, I really care about the environment and ESG. And we get these guys coming in and talking to us about wind and solar. And they say, don't invest in fossil fuels. That sounds like a great idea. I'm not going to invest in fossil fuels, because then if Concho goes to 70, I did it for moral reasons. And if Concho goes to 15, I'm buying that shit all day long and twice on Sunday because I finally think it's worth buying. So, the investment guys, they would sell their grandma for $1. And everyone knows that. So anyone who thinks that this is some moral high ground bullshit, anyone who thinks that Starbucks cares about Black Lives Matter, they don't. Starbucks is looking at their customers and they're saying, if we come out in support of Black Lives Matter and let our employees wear t-shirts, will we have more customers than if we don't? Should we cut our Facebook spending because people don't like Facebook and they don't like the hate? So will we get more customers if we make a public statement about Facebook than less? That's the only thing they care about. And so investors haven't left oil and gas because they feel morally responsible to make the world a better place. Investors have left oil and gas because there ain't nothing to buy that's worth buying. And if you've owned oil and gas for the last 6 years, you have been crushed as an investor. Crushed. So why the hell would I do that?
So that's what this was from Eric. Eric's actually, I believe he's based in France. Is there only U.S. companies on your agenda?
I mean, I think that the U.S. companies, because of the free market, have the best access. So can I buy shares in Saudi Aramco, and do I think they're worth it? I think the valuation is tough. I think the asset is great. Canada is an interesting one, obviously, because of the oil sands. But if you think about how ESG is impacted here, I mean, Canada's Liberal government is so anti-fossil fuels that even in the COVID time, they're talking about raising carbon taxes. And they have this like happy-go-lucky green feely stuff that just really makes it hard to see how Canada differentiates itself from the US. Then I look at Europe and the production sharing agreements and nationalization and Shell and BP and North Shore and Algeria. It's really hard for me to value those companies. So I don't spend a lot of time on them. I spend a lot of time on the US companies and the Canadian companies because they're easier to value and because we're a moat, especially on natural gas. You know, there's a little bit of LNG export, but like we're a moat. We're a very unique place and you can value these companies. So I can't speak as intelligently on valuation of other companies, but I feel like they would be the same.
So we do have this one that's going. So Calvin asked, this was earlier on, what's David's opinion on Kickstart and other crowdfunding options for the companies? This came in kind of early.
Yeah, I mean, look, I like to think, and maybe I'm not, and it's totally fine. And I'm very transparent about why I think what I think. So everyone on here can totally reject what I'm saying. I'm giving you all of the data and all of my conclusions. I would not put $1 into a US or Canadian E&P company because unless I have a thesis that oil goes to 60, I am going to lose money. So Kickstart and crowdfunding, you're supposed to get your money back. And so why would I invest in a business if I don't believe I'm going to get my money back? So that would be point one. And then point two is the companies. There's a stat that in the last 10 years, oil and gas companies have spent $342 billion more than they cash flowed. That means there's $342 billion of debt that needs to be repaid at some point. There ain't $342 billion of crowdfunding that's going to pay that off. And so, I mean, it's just not a big enough market. The only thing companies can do now is they can use their shares and buy other companies for shares. They can reduce the debt. They can lay off all the people. They can maximize their cash flow the best they can, and they can let their asset decline and try and survive as a zombie until the world oil has declined to a level that oil goes up to a price that make their asset worth it. And man, I just see that that's a 3 to 5 year process, and by then ain't nobody left.
So, David, let me ask you this. So what do you think is going to be left in, the oil and gas sector to even be able to do? Is it we're just kind of like waiting till,
we're waiting to die. And I wrote this post, and for me, March 7th was the day it changed. I didn't believe that we would lock down the U.S. economy. I didn't believe that was even the U.S. government would select large businesses over small businesses and crush the back of capitalism. Did not think that was possible. But because of the demand destruction, when the Saudis and Russians went to war March 7th, and they basically broke up OPEC and said now OPEC will no longer subsidize oil, I don't think OPEC will ever subsidize oil again. And so for me, March 7th is when I went from sort of like bullish oil at 60 because the US was going to decline because of lack of capital, and therefore the world was going to be balanced, to bearish. And I came out with an article maybe at the beginning of April that said 80% of jobs that currently exist in oil and gas will be lost in the next 12 months. And probably 80% of companies that currently do the activity of oil and gas production, midstream, and service companies will be gone in the next 12 months because They're going to bankrupt. They're going to consolidate. They're going to lay off. They're going to consolidate. They're going to lay off. They're going to consolidate. They're going to lay off. Because at $40, there are no wells that can be drilled in the country that are economic. And only natural gas at $2.50 is economic, but gas is currently $1.60. And the only reason people are drilling is because they have those firm transport commitments that I talked about with Antero. At some point, you have to pay the piper. And so I think the industry shrinks 80%. Now, the silver lining that I put in that is 40 million Americans were put out of work because of COVID. And so unemployment going into COVID was 3.7%, which is the lowest it's ever been. And if you remember 2014, the number of idiots we had in oil and gas that were sitting in chairs because you couldn't hire fast enough. Every company, Google, Apple, Amazon, blah, 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 have those same idiots sitting in chairs doing important jobs at a time when business has totally changed. And oil and gas professionals now have an opportunity to apply for jobs that they couldn't have applied for before because 40 million people have lost their jobs and the world is totally different. So it is an unfortunate state that oil and gas is going to shrink 80%, in my opinion. And I hate that. But you can pivot to other industries because the world is going to change so much that hotels are changed, airplanes are changed, restaurants are changed, and therefore everything that people do has changed. So you just have to find your new niche and make it work. That's sort of my view on that.
And I will add to this, you guys. Wednesday next week, we have a Vidor Locksmith with Amanda Rico, who is a resume specialist who's putting out amazing content for helping people to be able to do the job search during the downturn. She is she lives here in the Houston area. She's went to school at Texas A&M. She understands the oil and gas market, and she can help you either in the oil and gas market or being able to pivot out of it. So I highly recommend everybody tune into that one on Wednesday, or just go follow her on LinkedIn. She's putting out some great content with that. And like you said, David, I think, right now with the number of jobs that have been let go, there's also been the paradigm shift with now essentially it's okay to work from home or work remotely. So now I think the possibility for people to be able to get jobs in other geo markets without having to move has definitely shifted, which I think a lot of oil and gas people understand. They're already kind of used to the work from home or working remotely or being in charge of an operation that's not, in the same building. So I would reason to guess that I think a lot of oil and gas people will end up with some really good jobs as things start to kind of turn around and pick back up, or whatever the future may hold. I'm not going to make any slight bit of prediction on that. So,
I think, and David, I mean, I think that this is the important point, right? Is I've just gone through the last hour and a half talking about oil and gas balance sheets and debt. Debt is bad. Debt kills companies. Debt kills countries. The Fed has added $7 trillion of debt. So the market's rallying, everything's good. I mean, it's totally illogical and irrational to me that Tesla's trading at $1,200 a share today and that Amazon's at like $2,800 a share. But I can't comment on those companies, but I do know that they raised a lot of equity and they don't have a lot of debt. But for people, if you live in the Houston area, if you live in the Midland area, if you live in a oil and gas centric area and you have a lot of debt on your house and you're counting on your $150,000 a year, whatever your income is, to continue for the next 10 years, to be able to even kick the can down the road, it's hard to imagine. And Houston will be hurt. The job market will be hurt. The housing market will be hurt. And so if you are living beyond your means, you need to tighten your belt right now. And that might include selling your house. It might include reducing the number of cars you have. It might include dropping memberships to gyms and country clubs and going out for dinner, because debt is what kills you. And the reason that oil will go to 60 at some point in the future, but because of debt, the shareholders today will not live to see it. And so you don't want to have your house taken from you because you can't afford the mortgage payments and then have your house rebound in 3 years. So if you have debt, take care of your debt first and don't have debt. And take this as a lesson for the rest of your life. Do not use debt. It is a false prophet, and it is what will make you die.
I want to say to that, because I'm so glad you brought that up, David. This has been a personal message of mine, and I have no problem saying this. A lot of people might see me on my show and think that, I have my own business and stuff, but I will tell all of you guys, I am poor. Right? Like, I'm not going to sugarcoat it at all. I don't own a car. I borrow my brother's. I live in a 900 square foot duplex with my brother and my 2 kids. right? My rent is $900 a month, but I have zero debt, absolutely zero debt. My overhead is my personal overhead is extremely low, and it's what allows me and affords me the opportunity to be able to put together a show like this. One that does, I don't have sponsorship, I'm not getting paid for this, to be able to take time away from the business to be able to do this. So I implore all you guys, do not get caught up in the rat race of like being the directional driller out on the rig who has to have that jacked up truck or the new fancy thing. Just be more prideful in the fact of how cheap and frugal you can be. So please, David said it so correct. He hit it right there on the head. Get rid of the debt. All right. So now back to some of the questions that we've got coming in from some of the people here. So this one's from Saeed. He says, how is each share valued, and what are the factors that contribute to how many shares they sell? Does it increase, decrease, the values affect an overall financial requirement? Saeed, obviously, I'm guessing you're new to some of this stuff, but these are great questions because I think this is the whole point of the show, is that anybody can ask any type of question early on, late, and all of us can learn from it. So thank you so much for your question.
So how are companies valued? Animal spirits. And so a whole group of people, the whole world who invests, makes a projection on what a company is going to do. And they project forward cash flow statements running some form of model. And they have a whole bunch of money to invest because they work at a bank and people want to invest because they know they need to make more than 0% on their money. And so these hedge fund managers and pension fund managers and BlackRock and everyone says, I like this company, I'm going to buy it. And then the other person on the other side of the trade says, you know what, man, that seems really expensive to me. I'm going to sell it. And so prices of publicly traded equity is determined by the numbers of buyers and sellers. And the market is speaking every single second. So how are companies valued? They're loosely roughly based on valuation, but there's a whole bunch of assumptions like Tesla. Tesla rallied 10% today because they delivered more cars last quarter than people thought. They're now worth more than Exxon. They don't make money. They sell cars. Ford and Toyota and GM are car companies, and they are combined worth less than Tesla, even though they sell way more vehicles. Teslas are expensive. We're going into the worst economic depression since 1929. I don't know where people are going to have the money to buy Teslas. And yet Tesla is at $1,200 a share. I cannot explain it. I don't own it. But that's how things are owned. And generally, if you've been around for a long time, you know things work out really well until they don't. And I use WeWork as the example as a public valuation. They were seeking to raise $47 billion market valuation in September. And in 30 days, they were worth about 10 billion. And now they might be worth 3 billion. And they're going to go bankrupt because they have long-term leases that they can't rent. Because it turns out that putting a whole bunch of strangers that don't know each other in the same space, in small glass offices with dogs and babies, with a common room to drink beer and have coffees, and rent long-term expensive office space and rent it to people who have such an inferior business model they don't want to rent for more than 30 to 60 days. Turns out that's not a good business. And they went from a 47 billion valuation to 3 in like 30 days. So when shit blows up, it blow up real bad. But it takes a long time for things to blow up. So beware.
I think there was a news clip where I can't remember the investor. It's a real smart guy. He's a billionaire or something. He said it was a business built on long-term liabilities with short-term assets.
Yep. There was a question, David, that Calvin Holt asked. I think he sent me a text on it, so I just want to address it. Why is downtime, non-productive time, not included on the balance sheet?
Yes.
And so I would just say, I mean, because it's not, balance sheets are not meant to be it shows up because your costs are high. It shows up because your revenue is low, and so. But there isn't an item like balance sheets and financial statements and income statements that they're mandated by the SEC because you can learn things from them, but you don't learn anything about the efficiency of how a company is run. All you can do there is you can look at margin, You can look at profitability. You can look at the way a company is run. And so I use an EOG as an example. I don't need to know EOG's NPT to know that they run a very tight ship, because they've innovated, they found all the shales, and they run a very, very low debt balance sheet. So EOG is good. I don't need to know NPT at Sanchez to know that they were going to go bankrupt and that they were poorly run. And that the family was taking money out of the company, as has been documented in so many SEC filings and like insider deals and trades. So NPT is just not something that's a financial metric, like a lot of other things. Like it's a very numerical. How it's like the balance sheet. Like, it's not, the reserve value is not on your balance sheet. That standardized measure is buried way deep in there, and they don't want you to look at it. It doesn't show up on the balance sheet. Only the actual dollars spent and the actual dollars received show up in the financial statements. I'm so uplifting, aren't I? That's the thing that I really people take away is I'm a happy guy, optimistic. Just everything is great. It's a V-shaped recovery. Don't worry about it. Everything's gonna be great.
Well, I would like to point out, like, when I started making posts a while back about, directional drilling automation and directional drilling softwares and things like that, it's like people would get mad. I'm like, don't get mad at me. I'm just informing you of what's going to be taking place. The value proposition for your job is changing. And so I think, what you're doing is it's not so much that it's pessimistic. It's that you're informing people to be able to give them the opportunity to make decisions about where they go in their future. So with that, we have, I'm not going to even try to say this name, is renewable energy worth investing in? And we've had other people that have stated things about renewable energy. I think another one here, Michael Phillips, said renewable energy is more expensive than fossil fuels at $60. However, who knows if this in this current environment? So we've had some questions about that. We'd love to be able to get your hot take on that.
So, I mean, look, I used the example of Aubrey McClendon in 2006. Aubrey McClendon attacked the coal industry because he was creating demand for natural gas. And he did so by saying natural gas is clean and coal is dirty. Don't build new coal facilities. You should build natural gas power plants. And he spent a tremendous amount of money, including giving money to organizations like Greenpeace to be activists on behalf of carbon reduction. So make no mistake, wind and solar, the industry wants to invest trillions of dollars to replace the oil and gas industry because they will make billionaires. And billionaires are made from monopolies. Bill Gates, Jeff Bezos, Steve Jobs, Mark Zuckerberg. You go through the list of billionaires, and it was because they created a new industry and they were first. So that's why there's so much rhetoric around anti-fossil fuels. Like, it's crazy. But so I can't comment on, are renewables more expensive than oil at 60? The levelized cost of energy that gets done by Lazard and gets quoted suggests that now new wind and solar on a full cycle development using assumptions is cheaper than fossil fuels. Okay. But everyone is already, in my opinion, investing in that. It's like Facebook. Facebook sells ads. So did newspapers. The Washington Post went bankrupt. So ergo, selling ads has been a business that was done before, gets overvalued, and goes broke. So you investing in renewables, I would ask, what are you trying to accomplish in your investment? If you're trying to speculate that renewables are there, there's hundreds of trillions of dollars of investment professionals that beat you to the trade, that invested when it was private before it was public, and they went public to shove you shares of an overvalued company so that they get their out and they get new cash to do it again. So I'm just very cautious of investing in a thesis. What I believe in is what Jack Bogle said. He was the founder of Vanguard. If you're going to own something, buy the market. You can buy low-cost ETFs. You can own the S&P. You can own the NASDAQ. You can own the Dow. You can own whatever you want. Don't make bets on single industries and single companies because you just don't know what's going to happen. And like that, it can go away. So if you want to invest, put it in an ETF in the market, come back in 35 years, and you'll probably have done okay. You're on mute, David.
so hard to see this with like the sun glare and everything. It was kind of cloudy. I'm actually happy for bright sunny day out here. So after we get done with this, I'm gonna go on a hike or something or eat lunch. I don't know. Somebody asked, would you short Tesla then?
I mean, so many people have been short Tesla. I don't know. I can't value Tesla, and there's still money for tech companies. And so like oil and gas in 2012, 2013, when David Einhorn came out and said the whole sector is a Ponzi scheme, if dollars are going into a sector, like how the hell is Amazon trading at all-time highs? Like the world is so fucked relative to where we were in March. And yet the NASDAQ is at all-time highs. Tesla, a consumer car company, is at an all-time high beyond the valuation of Exxon. I can't explain it, but is it going to go up? I mean, I lived through 2000 when pets.com went public and got like $100 million for a website. So the market can be irrational because financial advisors get fees on your money. And they can't sit there and say, I mean, I had a meeting with my financial advisor yesterday. They said, I don't think you should buy more today, but I wouldn't sell. Okay, so you get your 1% fee, which is cool, and you don't want me to have my money in a bank account that's making no money because you don't make your fees. So they have all this money and they just invested in the best relative, like it's like the tallest midget. So Tesla right now is the tallest midget. I can't short the tallest midget. But in oil and gas, I can tell you there's 1.5 billion barrels of oil floating on the ocean and in storage somewhere because of the overproduction. It's owned by financial players that will sell it back to the market. Therefore, it will depress prices. Demand is down. The OPEC has shut in 10 million barrels a day that will come back to market. Iran is down 2 million barrels a day that could come back to market. Iraq is down. Libya is down. Shut-ins are coming back, and wells aren't economic to drill in the U.S. So I can tell you that fundamentally, the oil and gas industry, which is an asset value industry, is not worth where it trades. Therefore, I feel more comfortable shorting it than I do Tesla, because I sold Tesla out of my account at $300 a share like a year ago. It's now $1,200 a share. Do I look like an idiot? Sure. But like, how the hell do you justify valuation like that? I can't, but I can't short it either.
Well, Elon Musk did come out and put out the tweet that he thought that their value was over, or that their shares were worth too much.
Amazon. Last time I checked, Amazon delivers packages that it resells from people who have jobs that buy it. Well, if you don't have a job, you ain't buying stuff, which means Amazon isn't moving things. And they traded 126 times forward earnings. Amazon would have to grow 30% a year every single year for like 15 years to meet that projection. And they are already the world's largest company. So what are they going to do? A $50 trillion company at some point? I mean, it just is totally irrational. But again, can you short it? I mean, anyone who's short the market right now is getting their face ripped off and having it shoved up their behind.
Yes. I have a question for you. So I'm still seeing a lot of oil and gas startup companies, these small service technology companies. Are these guys that are just like, maybe it's the fact that like they've already been working on something for the past year and just now getting into the market, or maybe some people have been laid off, they're trying to start up something new. Should they just completely pivot out and go to another industry, or is there the chance to be able to help fix some of the problems that these oil and gas companies have created with new startups, digital movement and things of that nature?
So when we started One Energy, and we weren't the same scope and scale, we started in 2016. And what I did was I declined every horizontal well in the United States. And I know that this is going to be shocking, so I hope everyone's sitting down. The reason that we won was because I found the best wells in the United States, and we bought land as close as possible to them. And so we were 3 miles from the best wells in the United States, and we were able to buy it at a good entry price. And then the market reflected what the reserves were, and then they were sold for a lot more than we paid. That didn't take digitization of the oil field. That took like Excel. And so the problem that I have with the digitization of the oil field being the game changer is all the rock in the United States and Canada worth owning is already owned, and it's badly capitalized. And so the issue of our business is not like that you can do things cheaper or better, or find new ways to make the rock better or whatever. The rock is the rock, and costs are the costs, and you know it already. So digitizing that doesn't make a difference. It's why I really struggle with the whole model of like, we can make it more efficient. Sure, 10 companies will survive. They'll be more efficient. They'll cut costs. But for 90% of people, that's not helpful. And for 90% of investors, since they're already trading massively overvalued, that's not helpful. So I think everyone's going to have to pivot into a new industry. I don't know what that industry is, but I know that the world is different. And a tremendous number of new companies that we never would have contemplated before will be started in the next 3 years. And they'll be, trillion-dollar companies. I just don't know what those are yet.
Well, David, I want to say this. Thank you so much for your time. We've the questions and comments are starting to slow up, and we're almost reaching 2 hours of having you on here. And no batteries died. So hallelujah. Thank you. We made it through and got an actual full show in. David, thank you so much for taking part of this. Any last words for anybody that's still out there listening or is going to watch this later on?
Yeah, look, it sounds doom and gloom, but in crisis is opportunity, really and truly. And if you don't have personal debt, you can make the changes in your life, whether it's moving to a new state, whether it's moving to a new industry, whether it's moving in with your parents for a time being. Like, the world is now different. And it is massively different, and it's split up along political lines. It's split up along income lines. It's split up along racial lines. And on those fault lines, there will be opportunity that you just need to be mobile and try and survive. And so be happy, be safe, do your best, and things have a tendency of working out. But it is a really tough time right now for oil and gas, and hope is not a plan. So knowing it is the first step of self-awareness.
So, guys, I highly recommend, if y'all have not already, follow the hashtag Hot Take of the Day on LinkedIn. David is constantly putting out great content and has great explanations that go along with it. He's also got his own podcast. Take a listen to it as well. It's better than this one will ever be. Be sure to.
I'll give you, it's more controversial.
And if you haven't already, send him a LinkedIn connection request. I think he probably approves the majority of them, unless you send him some spammy messages to begin with. And then if you guys haven't connected with me, go ahead and do that. Follow the hashtag Vidor Locksmith. We've also got the YouTube. So all of this will be on YouTube. It'll still be here on LinkedIn. It's a little bit easier to watch on YouTube. I think our viewership is leaning towards actually all of it going over towards YouTube. So thank you guys all for watching today. We really do appreciate it. All the questions, the comments. This is what's going to help all of us throughout this current journey, is to be able to have these types of conversations and be able to educate ourselves a little bit further. David, once again, man, thank you so much for coming on the show. I do appreciate it. And you guys that are out there watching, please give me some good feedback, bad feedback. I really don't give a shit. Whatever, just give me some feedback. Who do you want to see on the show in the near future? Next week, like I said, we've got Amanda Rico on Wednesday, and then on Friday we've got Peter Aird. The following week, I believe it's Mark Anderson and Kurt Meyer, and then the IBM machine learning and artificial intelligence team will be coming on to do some educational stuff. Once again, thank you guys so much from Cloudcroft, New Mexico, here on the edge of Lincoln National Forest. I'm off to go do some fun stuff because I'm on vacation. So you guys have a good one. David, thanks so much, and we'll see you guys in the next one. Where's the button? I forgot to pull it up. I think that's it.